Hello, everybody, and welcome to today's Portugal Pathways webinar. Thank you for joining us. Today's webinar is all about mitigating tax on UK pensions in Portugal. As I said, we are looking at how we structure different approaches that may help individuals manage their Portuguese tax exposure on investment income. It's obviously always dependent on each individual's specific circumstances. Our panelists will also outline general considerations around UK inheritance tax for those already living in Portugal and the key rules that determine how various types of pensions are treated for retirement income under Portuguese law. Our panelists will also provide sort of high-level guidance on the legal and compliance frameworks that typically influence how UK source pensions and assets are taxed once someone becomes resident in Portugal. Please note that all information shared is for general education only and is not personal tax, legal or financial advice. So let's introduce today's panelists. Firstly, we have Rex Cowley. So Rex is Director and Co-founder of Overseas Trust and Pensions. Joining Rex, we have Matt Furman, who is the CEO at St James Global. And alongside Matt, we have Paul Nicholson, who is Group Executive at St James Global. So welcome to you all, and obviously thank you for being here today. So many people moving to Portugal discover that their UK pensions or benefits are not taxed in the way that they expected. Why is this such a sort of common issue for British nationals? And what are the main things that tend to catch people out? Rex, perhaps we can sort of start with you, and then I'll get Matt and Paul to come in behind you with their thoughts.
Yeah, thanks for that, and hello everybody. I think the concept of pensions is often overly simplified by us as people. I've got a pension and that's it. But the nature of the pension has a lot to do with it. So is it state pension? Is it an occupational pension? Is it a personal pension? Or maybe you've annuitized a personal pension. So there you already have 4 different types of pensions, and each of those are going to be taxed differently. So I think what you've got to do is the devil's in the detail. It's the complexity. It's in terms of understanding what kind of pension structure you have, and then how does that get treated in Portugal. And as I said, the treatment on those is going to be slightly different. I also think the other thing that people should also take into account is, when you're in retirement, you're not just relying on your pension. You're relying on often your investment income, some of your other maybe tax-efficient savings in the UK, and you'll be drawing on those to supplement your pension or your retirement income. And the considerations of how those are going to be taxed, which are often tax-free in the UK, aren't necessarily tax-free in Portugal. So I think the devil is in the detail. I wouldn't say it is complex. It just requires people to understand and to get into the detail, and hence get advice specifically at that granular level.
Thank you, Rex. Matt, Paul, anything to add behind that?
Yeah, I think it's really important to understand if you are leaving the UK and coming to Portugal, you have the ability to, under certain rules, be a non-tax resident in the UK. Because the last thing you really want to do is be tax resident in both camps, i.e. tax resident in the UK and tax resident in Portugal. So if you can follow the rules from a UK point of view and change your NT code, then that means that you won't be paying any taxes in the UK on your pension when drawing that. And if you structure the asset correctly in Portugal, it has some massive tax benefits. And it's really about making sure that you're not having two boots in both camps from a tax point of view, and then structuring the asset and legally, legitimately, using all of the tax code in Portugal, and you can end up paying very little, if none, tax on your UK pension. That's really what a lot of our clients are looking to achieve.
I would also add, if I may, I think the experience we've had is that once our clients become tax resident in Portugal, and once we assist with the restructuring of those assets, from a tax reporting point of view in Portugal, there's so many different boxes, and I think it's absolutely critical that, from a tax administration point of view, that the right boxes are ticked. And it's also equally important finding somebody, who understands from a Portuguese tax perspective the product, and also from an international tax perspective the product. There's so many times that our clients go to an accountant or a bookkeeper, and there's the incorrect tax reporting. So very important that one gets that correct.
Lovely. Thank you. It's a great overview. Paul, people often worry about making changes to their pensions or assets in Portugal because they think that they might move back to the UK in the future. What happens if someone structures everything for Portugal and then decides to return?
Well, that's a very important question. I think a lot of our clients tend to be very portable. It's very often the case that clients have to return to the UK for health reasons, for example. And I think as a result of that, first and foremost, we need to ensure that there's continuity of management, there's continuity of service, reporting, and that the structure can remain in place, albeit we may have to tweak or change or amend the trust deed to make it UK compliant. And that certainly is achievable. There are a number of ways that one can do that. I think first and foremost, one would have to appoint a UK regulated advisor. There are ways that we can revoke the structure, we can resettle or reassign the assets into one's own name. We can use, if you like, discretionary trusts, or we can use UK compliant investment bonds. There are ways that we can stagger the income, for example, on the basis that one would have controlled access to the capital. And the ways of using what are called excluded property trusts for beneficiaries and for contingent beneficiaries. So the long story short, to cut a long story short, we can restructure the assets in the event that one returns to the UK, but actions have to be taken prior to making that decision and prior to actually moving. So all we would say is that the first move would be to contact us or a financial advisor regulated in Portugal who also understands UK law and can make the necessary amendments prior to one departing.
Look, thank you very much. And for anybody, obviously, who is in the audience today, who that applies to, or they think that is a scenario that might happen, I mean, please reach out to us at Portugal Pathways, and we will align you with one of the guys on the panel who can then assist you and talk about your sort of personal circumstances. Rex, many people want to know how they can reduce their tax rate in Portugal to a very low level. In simple terms, how would this actually work?
Okay, I think the first thing is, when it comes to Portuguese tax, it's categorized. Income is categorized into effectively A to H, different forms of income, and retirees are very much incentivized in Portugal. So if you retire in Portugal, it's a very, very tax advantageous system for people that have retired. That's one of the beauties of Portugal. So what you really want to do is ensure that the income that you're deriving sits within what they call category H, retirement income, because retirement income in Portugal is incredibly favorably taxed. So as an example, if you have an annuity running, only 15% of that annuity is going to be typically subject to taxation. So if you had, for every €1 you were earning, only 15 cents might be subject to taxation at your marginal rate. So you could end up paying, single-digit numbers. And that's how the legislation's been designed, specifically to favor retirees. So you want to try and get as much income into the right category as possible, which often means that you restructure your fares to make sure you take advantage of products that qualify for category H, as opposed to investment income, which gets taxed at a much higher rate. So it's about understanding the different set categories and ensuring you take advantage of products that qualify within those different categories, and then you tax accordingly.
Yeah. Thank you, Rex. Thank you. Matt, another sort of common question is whether people would still pay capital gains tax if they buy and sell investments inside a structure. So again, how does that sort of work in practice?
Yeah, the great news there is buying and selling the assets. So you buy at 100, sell at 200. You would not be liable for the capital gains tax in Portugal. Quite simply, the reason why is the way that the structure works. It's exempt from capital gains tax in Portugal. So it works incredibly efficient. Buy at 100, sell at 100, you don't owe the taxman anything. So that's very useful. And that enables you to manage the assets within this structure a lot more efficiently. So we find that if people don't have their assets structured correctly, they're really looking to trade assets and then look for losses to offset capital gain. Where here, there is no capital gains to be paid. So you can't get better than zero, and zero it is.
Lovely. Thank you, Matt. And again, staying with you, Matt, what does someone need to know about becoming a tax resident in Portugal? You know, what are the basic rules around days in the country and reporting income, for example?
Yeah, this is nice and easy as well. Obviously, you've got the UK, which is slightly more complicated, but Portugal is very simple. It works on a calendar basis, so January 1 to December 31 each year. If you spend more than 183 days in Portugal, then you are deemed a tax resident of Portugal, must report and liable for taxes there. The only other question that you need to ask yourself is if the property that you have in Portugal is deemed, or you deem, as your primary principal residency, then you have to report taxes and liable for taxes in Portugal, regardless of the number of days. So it's very simple. How many days do you spend in Portugal, and the property that you stay at, do you deem that as your primary principal property?
Gotcha. Understood. Thank you. Again, come to you, Rex. Again, people also want to understand inheritance tax in particular at the moment. And what's the position in Portugal, and how does it differ from the UK?
Okay, so effectively in Portugal, there isn't really an inheritance tax regime. There used to be, it got disbanded many years ago, and there is a transfer tax regime that does take place. But when we talk about things like life insurance and pensions, they're excluded. So if we given the conversations around pensions, there is no inheritance tax effectively in Portugal on pensions, which again makes them very efficient. From an income tax perspective, efficient. On passing, very, very efficient, so that the wealth can pass to your beneficiaries without taxation. So in a very, very favourable regime, which is quite different to the UK. And I think for a lot of listeners, you might be from British origin, you are from the UK, you're coming to Portugal, or you've been here for a limited time period. And now you know that the UK changed their law recently, and up until last year, if you were UK domicile, you were subject to UK inheritance tax for life. Now they've got this long-term residency rule, which if you fall within the test, you're subject to UK inheritance tax on your worldwide assets until you sit outside of that test. So understanding where you sit, do you pass or are you in the test or outside of the test, is really critical, as that will determine IHT from a worldwide perspective, from worldwide assets. If you're outside of that, then it's only UK situs assets that become subject to UK inheritance tax. And this is where we're seeing a big shift. For many years, people of British origin living outside the country have always kept assets in the UK, and they've enjoyed doing that. They understand it. They understand the rules and regulations. But people are becoming more and more disenfranchised with the UK, and also given that these tax changes have taken place, you can now mitigate IHT simply by moving those assets outside of the UK. Doesn't mean you can't have exposure to UK markets. Of course, you can still invest in UK stocks, but you're just holding them outside of the UK. So for people so the big ones there are Portuguese inheritance tax doesn't really exist when you're talking about pensions. The UK, it does. And of course, from 2027, UK pensions will become subject to inheritance tax for the first time. So a hardening tax environment in the UK, which is why we're seeing people leave, and understanding your position in terms of long-term residency. And again, you'll need to get advice on that as to where you fall. If you're within LTR, long-term residency, IHT is an issue for you. If you're outside, it's not an issue, but you do need to get rid of those, or you need to move your UK assets if you have those assets out of the UK, or inadvertently you'll get caught up in UK IHT.
Lovely. Thank you, Rick. Thank you. Matt, a lot of people want to know what they can actually hold inside these structures. What sort of kind of assets can be included?
There's certain rules that can be assets that can be held, but basically, as long as it's quotable, tradable, then it can be held. It needs to be listed in some way, shape, or form, so it can be tradable. But the world's your oyster. You can hold, realistically, anything you want. You can't use leverage assets. You cannot put in your primary principal property. So physical property can only be held in the structure if it's held within a company, and then it can be held within the structure. But in short, basically, as long as it's legal, as long as it's quotable, as long as it's tradable, it can be held.
Sorry, can I just add to that, Matt? It's quite interesting in recent months, going back to what Rick said, having a lot of British nationals who are looking at disposing their UK citus assets. We've had a lot of requests from clients who have UK companies and wish to, set up a structure under the appropriate deed and have the shares of that UK company transferred into their Portuguese compliant structure. And that can be done, and that has potentially significant tax advantages. So you have the Portuguese compliant structure holding a UK company shares, and there's a whole set of tax benefits around that too.
Thank you, Paul. And also, same with you, Paul. A lot of people again are asking how they know that this advice is backed up and recognised by the relevant bodies. What support or verification sits behind the structuring that you guys do?
Okay, well that's a very important one, because over recent years, I've been in this industry for donkey's years now, and we still come across clients who hold, as beneficiaries, the old discretionary trusts, which are seen by the Portuguese tax authorities as toxic. In particular, if those trusts are set up in privileged tax jurisdictions, and they are taxed very highly, up to 48%. So as part of our advice, we've taken a bespoke tax opinion at the highest possible level. And first and foremost, we've looked very closely at the Portuguese government anti-avoidance rules. And we've looked at that both here and abroad, where the structure sits. We've written the structure under perhaps one of the most robust pieces of pension legislation in the world. And we've got three separate tax opinions, of which are updated annually by our tax professionals, who are probably, as I said, one of the largest tax attorneys in Portugal. And I think also in setting up these structures, we have to say to ourselves, what is our customers' intent? Why are they doing it? How much substance is there behind doing this? To the extent where it's a very commercial deed, it's a very defined deed, so it's only the member who can benefit during their lifetime. So it cannot be seen as an anti-avoidance scheme. What sits at the top? Is it a discretionary trust to get away without paying tax? No, it's a pension underwritten by a very robust piece of pension legislation. And to the extent that we do have a number of clients who say to us, well, we have assets in multi-jurisdictions, can we please arrange for a bespoke tax opinion, taking into account not only our advice, but also their assets in multiple jurisdictions? And that will cost a couple of €1,000, but in most cases it's well worth it.
We've also gone to the extent of getting some tax rulings in Portugal. So this is where we take a set of scenarios to the Portuguese tax authorities and say, if this happens, are we right in saying how it will be taxed? And we do that once a year and get a tax ruling from the tax authorities. So you can't really get stronger than that. We've got the highest legal opinions, and then we've also got approval from the tax authorities in Portugal saying, yes, that opinion is correct.
Lovely, thank you for clarifying all that. One sort of last sort of general question before we get on to the sort of Q&A side of things. And again, one for you, Rex, here. Something that often sort of causes confusions. Are these assets subject to probate, or does the structure sort of avoid that?
I mean, one of the beauty of pensions is that they sit outside of your will, so that they're dealt with by the pension trustees. And the importance of that is the assets go to your dependent quickly. You know, you're talking about 2-3 weeks, not 6 to 12 to 18 months. So pensions are incredibly useful for succession planning. As we've already identified, there is no estate or inheritance tax on them from a Portuguese perspective. So if your spouse is a Portuguese tax resident, when you pass away, it's a seamless transfer of assets. So the answer to that is no, there is no probate process. You don't need a will because it's also dealt with by the pension scheme itself. Of course, that doesn't apply to assets that sit outside of that. So if you hold other assets in your own name, of course, you're going to have it's going to go through probate, or you need to have a will in place to deal with those. But very, very efficient in terms of pensions, in terms of succession of assets, administratively, and of course efficient from a tax perspective.
Can I add very briefly onto that, if I may? And it's very often the case that we have clients who have assets in different countries, and they don't realize that if those assets are held in their name, if anything happens to them, they have an estate in each jurisdiction in which those assets are held, and ultimately the global assets will have to be administered in Portugal under Portuguese law. So once again, with the right type of structuring, through the letter of wishes, completely bypasses the probate system, with assets passing on to heirs.
And just to add to what Paul's saying, you know, if you pass away with assets in a different country, yes, the administrative process of getting them into the beneficiaries' names, but also it's what's the tax position on death with regards to those assets. And I know we talked about inheritance tax a little bit, but remember, some jurisdictions also have the concept of wealth tax, which can also apply to the assets where someone has become deceased. Even if they're not tax resident in the country, the asset gets subject to taxation. So that is a significant area that is overlooked by people, is taxation and transfer of assets on death, because I have a will, covers my worldwide assets, but that will is not actually valid in the country where I hold the account. So yeah, I think it's a very big area that needs focus.
Okay. Thank you guys for clarifying. So we've got a lot of obviously engagement and questions in the chat. So I want to sort of move on to those. Before we get going, just to say that if we don't get around to answering all of the questions today, that the team at Portugal Pathways will reach out to you individually with answers, and obviously give you that opportunity to schedule an initial discovery call with one of the experts on the panel today. Again, just so you can schedule those discovery calls. My colleague behind the scenes will just put that call to action and that button back on the screen for you. So just looking at some of these questions coming in, we've got a question here from Eric, and Eric asks, what happens if I structure my assets for Portugal? Oh, to say we won't answer this, but maybe we can reiterate for Eric. What happens if I structure my assets for Portugal and then years later return to the UK? So obviously that is a question on lots of people's minds. Rex, again, do you want to sort of go through that one?
I can do. I think the challenge, Eric, is that years from now we have no idea what UK tax law is going to even look like. So I always say you must plan for today. If you try to plan too far into the future, it's going to be challenging. But what we generally say to clients is internationalize your wealth. Don't hold it in the country that you live. So don't hold it in the UK, don't hold it in Portugal, hold it in an international jurisdiction where it's neutral. Because from there, it gives you the most flexibility in terms of planning. Now, it might be that in years to come, you have to unwind all of that because the UK rules and laws have changed to such an extent that what you have is no longer compatible. Might be that it actually is perfectly compatible. But I always say, consolidate assets internationally, hold them in a neutral jurisdiction, and then you can plan from there. So trying to plan too far into the future usually comes unstuck.
Okay.
Just to flesh a little bit more out on that, we've had a number of clients move back to the UK recently for various different reasons. And what they're able to take advantage of in the UK is to move back and use a piece of UK tax legislation called foreign income and gains. What that enables you to do within a period of time is unravel all of your global assets, move them back into the UK, and you're not paying any income tax or capital gains tax at the point that you enter into. So it can be incredibly efficient, and then you just start again from a UK point of view.
Yeah, if I could just add to that, we've never had a point in time where it's been so efficient to be a British expat going back to the UK. I mean, it's never been this efficient. It's quite opposite for those living in England. But as Matt was saying, you can go back if you're outside of long-term residency, enjoy 4 years tax-free, restructure from that point as well. But also, depending on how long you've been out, you could also be outside of the UK for 10 years in terms of IHT. So incredibly efficient if you put your things in order, your affairs in order before going back to the UK. So currently, really, lots of opportunity if you do go back to the UK. Just don't leave your assets there if you're living abroad.
I think we can't lose sight of the fact that Mrs. Reeves has a public hole, finance black hole of somewhat 40 billion, I think they're saying. Yes.
Yep, there's a big hole to fill. A question from Andrew and Paul, if you could take this one for me, please. Paul saying, how do I use the foreign income and gains rule in the UK when returning?
Okay, so sorry, I'll take that one. Basically, it just is, if it's the right thing to do, is to unwind the structure and go back to the UK. From a tax point of view, you've got 4 complete tax years to unwind, and it really is just unwinding that and then filing that in your first or the year that you unwind the structure. No taxes to be paid at that point. So, touching on Rex's point, it's hugely efficient.
And it's just ensuring that you are claiming that on your actual tax return in the UK. You need to be claiming it under the relevant section.
Love it. Thank you. Again, Matt, we'll sort of stay with you on this one, I think, unless Paul wants to jump in. But this is a question from Tim. Are the assets still subject to capital gains at any stage?
Do you want me to say that? Yeah. Okay. So at any stage, no, they're not subject to capital gains tax. They're completely free of any capital gains tax. That's because the structure itself is exempt. It's only when you do something more interesting with the money that it's subject to taxes. And from a Portuguese point of view, if you're still in Portugal, your tax rate, depending on how much you take out each year, but you can be talking between 0.5 and 1.5% per year. So effectively, draw 100,000 euros worth of income, sterling's worth of income, you'll be looking at 1,200 euros worth of tax liability in Portugal. So that's where the efficiency is, no capital gains tax, and then passing those assets on to the next generation, structured correctly, can be incredibly efficient as well.
I think it's also probably worth mentioning that a number of clients are perhaps, should I say, sentimental over their assets. They may have inherited stocks and shares, or they may have an existing relationship with a UK discretionary fund manager, in which case those shares can be retained and transferred into the structure and then sold within the structure with potential capital gains tax advantages. So you can have as much or as little involvement in the management of those assets once they're in the structure. And most of our clients don't want that, but a number of them have very substantial portfolios and they want to retain that relationship. So that can be done very simple in-specie transfer, getting the assets out of your name, getting the assets out of your estate. In fact, that's very much a starting point in our advice process, is focusing on the structuring of the assets, giving you the peace of mind, getting the assets out of your estate, all protected under the letter of wishes. And as the next stage, we'll have a look at the investment planning.
Lovely. Thank you for clarifying. I think we'll go for one more question before we wrap up, because we're going to try and keep this into that sort of half an hour slot. So this is a question from Kate. Maybe Rex can take this one on. What are the practical residency requirements for Portugal, and how do they apply to your part-year movers?
I think as Matt mentioned right at the start, it's very simple in Portugal. If you spend 183 nights or more in Portugal, you are tax resident. So it's very important to practically count your days. However, the caveat is if you have a home at your disposal in Portugal, the Portuguese tax authorities can argue that actually you don't have to worry about the days you are tax resident. And remember, a home doesn't have to be something that you've bought. If you've got a long-term lease and you've got access to a property for more than 183 days a year, the tax authority could very easily argue that evidences that that's your home. So count your days, be mindful of where you're staying, particularly if you don't want to become tax resident in Portugal. I would say quite the opposite is true. You probably want to become tax resident in Portugal.
Absolutely, yeah. Gotcha. Thank you, guys. So just before we sort of wrap up today, I just want to say to the audience, again, just to reiterate, if we haven't got to all of your questions, then the team will reach out and answer those questions or align you for a discovery call with one of the guys on the panel today. Again, before we go, I just want to really go around the room in terms of the panelists and just ask them for sort of like, you know, a soundbite, one final piece of advice that they feel that the audience needs to take away. So I'm going to start with Matt.
Yeah, I always say to clients, if Portugal's right for you from a lifestyle point of view, it's definitely going to be right from a tax point of view. But lifestyle is more important. So if you need to make sure that Portugal's right from a lifestyle point of view, and then structuring the assets correctly, it's going to be perfect from a tax point of view.
Lovely, thank you. And Paul?
I would say not to forget one's beneficiaries. And it's very often the case that we structure assets for husband and wife, but we tend to ignore where the beneficiaries are tax resident. And there's some very, very tax efficient ways of removing the assets from inheritance tax, for example, in the hands of beneficiaries.
Love, thank you, Paul. And finally, Rex.
My only thought is it's never been as good a time to be an expat as it is today. And therefore, I'd say people really need to take advantage of that fully. And by that, I mean, really get to understand what your proper position is, your detailed position is, and plan from there so that you can actually maximize the decision you've made to become an expat.
Lovely, thank you. So it just leaves me really to say a big thank you to our panelists today, to Rex, to Paul, and to Matt. Thank you to the audience and for your involvement. As I said, we will be getting back to those that have requested a discovery call or have sort of indicated that they have got some questions that are a bit more on the personal side of things. Just to let you know that our sort of next webinar is on November the 25th, and it's all around unlocking opportunities in Portugal's luxury property market. So yeah, if you can join us for that one, again, we'll share the link, and obviously that again is on our website, which is www.portugalpathways.io. So thank you everybody for your attendance today, and thank you guys for that expert opinion, and we will see you on the next webinar. Thank you very much.
Thank you.